someone bought 11,000 December 2026 COMEX gold bull spreads between 15,000 and 20,000 after the crash, not before it. When silver's at $100 and we have short positions at 60 that are bleeding, well, we're going to give you one last chance, and we're going to get Jane Street involved. The desk made $1 billion that year. Retail sold the panic. Large buyer used the washout to build a 1.1 million ounce tail risk position. Cost them roughly $3 million. If it gets above 15 and gets up to 20, they win. If it gets above 15, they make a fortune, and then they sell 20. Who would spend $3 million thinking that by the end of December, we get to that point? And I would argue that what they are betting on is not gold. They're betting on exploding U.S. debt, betting on war spending, on increasing inflation, slowing growth, maybe even a recession. The energy choke point in the Straits of Hormuz, the fertilizer problems, the food pressure as a result of it, the sovereign strain that we're seeing all around the globe, and as a result, de-dollarization. You have the ability for the price to really slingshot when demand jumps into it. Bloomberg reporting about Chinese customs data. 790 tons of silver imported in the first 2 months of 2026. February alone was 470 tons, the highest monthly import volume ever recorded, as metal is dumping here. And to me, what it signals is that lower prices are not weakness, they're opportunity. This is accumulation, this is positioning. And remember, there's a buyer for every seller. And the buyers of this panic are the smart money traders. The people that know the fundamentals haven't changed. And this is only a normal sentiment reset to build the next fuel for the leg up. And why do I say that it's structural, not fundamental? Even the Bank of International Settlements came out and said, this is structural. This is not fundamental. It's structural in the respect that they said it is an increase in the massive amount of levered ETFs that had to reset in January. They had to rebalance because December, the price up. They had to rebalance. And then margin increases, up. Everyone got squeezed like a grape. And they did. And so the leverage has disappeared to the point where Ed Steer, your buddy Ed Steer, great guy, is saying that it's the lowest short position that the commercial banks have ever had by a long margin in silver, ever.
What looks like panic selling is quietly becoming one of the largest accumulation events in years. As Andy Schectman points out here, China importing 790 tons in just 2 months, 470 tons in February alone, doesn't align with a weak market narrative. This suggests forced liquidation from leveraged ETFs in January created artificial price pressure, not a collapse in demand. When commercial short positions are at historic lows, it often signals repositioning, not risk-off behavior. Investors should question whether this sell-off is engineered to reset positioning before a liquidity-driven move higher. Next, Andy Schectman unravels how institutional positioning may be shifting beneath the surface.
So could it be that they knock the hell out of it to get on sides, to increase their long position? You know, the Economic Times said they're net long a while ago. That could be 11 long, 10 short. They're still short a lot, but net long. Well, are they getting more and more and more and more long? I would argue they are. And so, you know, I think you need to kind of look at these things with a little bit of I don't know, you have to look at things, maybe not, you have to think outside the box. We can talk about things that are happening, again, that will massively change things. You know, India, as of, April 1st, has mandated that gold and silver ETFs switch from the London benchmark to domestic Indian exchanges as of April 1st, because it's a loss of confidence. They don't trust the Western benchmark price. Well, that's the same exact thing that we see happening, I think, around the globe, a loss of trust. And I do believe here in the US that the big banks have covered a huge position, a portion of their shorts. Open interest is incredibly low. There's been a lot of silver and gold that have been leaving the exchanges. These are, I think, when you have open interest as low as it is right now, that basically means that there's not you don't have the managed money willing to take the other side of all of these trades, these short positions that the banks are putting on.
Markets don't crash randomly. Sometimes they're pushed to reset positioning. As Andy Schectman points out here, the idea of banks turning net long while prices fall raises a critical contradiction investors shouldn't ignore. India's April 1st shift away from London pricing signals a broader breakdown in trust toward Western benchmarks, which historically precedes structural market changes. Low open interest suggests institutional participation is thinning, meaning fewer players are absorbing risk, often a precursor to volatility spikes. This isn't just about metals, it's about confidence in pricing systems globally. Next, Andy Schectman discusses why low participation could trigger outsized moves.
And when you have low open interest, that means that you have the ability for the price to really slingshot when demand jumps into it. So look, all I can tell you is that all is not as it seems. Price is a tool of misdirection, and as the price has been hit, we're seeing so much in the way of deliveries here in the United States on COMEX, a lot of it leaving. 2 million ounces left the COMEX vaults on Friday. Just bye, see you later. You know, the numbers of offloads or loadouts, as they're called, where metal is leaving COMEX is getting bigger and bigger and bigger. Once it leaves, where's it going? It's never coming back, ever coming back. And this is an important thing to think about. It's one thing to see lots of deliveries. We are seeing lots of deliveries. It's another thing to see lots of metal leave the COMEX ecosystem. It is never coming back. And this, to me, at the same time China is loading up, at the same time India is moving benchmarks away from the West. These are all things that I think are really, really important to understand. Metal leaving the ETFs, yet at the same time, the exact same amount leaving the COMEX. Is it filling a void so that it doesn't look as bad as it really is? I don't know.
The real signal isn't price. It's where the physical metal is going. As Andy Schectman points out here, 2 million ounces leaving COMEX in a single day isn't just flow. It's a structural drain on available supply. When open interest is low and physical inventories are shrinking, markets become fragile. Small demand shifts can trigger outsized price reactions. The key risk investors miss is that once metal leaves these systems, it rarely returns, tightening future liquidity. Meanwhile, global buyers like China continue accumulating, creating a divergence between paper pricing and physical demand. Next, Andy Schectman shows how this disconnect could reshape pricing dynamics.
Well, I mean, it certainly is interesting when you see the exact same amounts match up. When you see 1,253,200 ounces of gold be delivered here in March and 43,565,000 ounces of silver, and the week or the month isn't over yet. These are all things that people need to understand. And this is why there is an entire theory of investing called wave theory, Kondratiev wave, Elliott wave, where it measures the cumulative emotions of the herd. 2 million ounces of silver leave on Friday, just load it out. There it goes, bye-bye. But that, according to Ed Steer, 102 million ounces of silver in January and February combined, plus 26,716,000 ounces of gold so far in March, were loaded out. And we're well into the 6th year of a structural deficit. So, what are we talking about? Actually, that's delivered. Excuse me, that's delivered. I don't know exactly how much has been loaded out, but a lot. We saw 28 million ounces loaded out in February alone. So when you see all of this metal being delivered and a lot of it being loaded out, meaning leaving the system, delivered could mean just going right into the eligible category.
When delivery volumes surge during a price decline, something deeper is unfolding beneath the surface. As Andy Schectman points out here, over 43 million ounces of silver delivered in March, alongside a multi-year structural deficit, challenges the idea of weak demand. This pattern often reflects distribution from exchanges to stronger hands, not liquidation, wave theory may explain sentiment swings, but it doesn't explain sustained physical outflows during declining prices. Investors should question whether this is a transfer of ownership from leveraged players to long-term holders. Next, Andy Schectman unravels how supply deficits are quietly tightening the market.
Couple other things, and then I'll jump on any questions you have. You talk about speculation. Someone bought 11,000 December 2026 COMEX gold bull spreads between 15,000 and 20,000 after the crash, not before it. But what that basically means, there's a huge volume there. What that means is a bull spread, 15,000, 20,000 bull spread, a gold call, is that they buy 15,000. If it goes above 15,000, they win, and they sell 20,000. That spread between 15 and 20,000, they make a ton of money. This is the key point. Retail sold the panic. Large buyer used the washout to build a 1.1 million ounce tail risk position. Cost them roughly $3 million. And in other words, if it gets above 15 and gets up to 20, they win. If it gets above 15, they make a fortune, and then they sell 20. Who would do that? Who would spend $3 million thinking that by the end of December we get to that point? And I would argue that what they are betting on is not gold. They're betting on exploding U.S. debt. They're betting on war spending, on increasing inflation, slowing growth, maybe even a recession. The energy choke point in the Straits of Hormuz, the fertilizer problems, the food pressure as a result of it, the sovereign strain that we're seeing all around the globe, and as a result, de-dollarization.
Smart money doesn't chase rallies. It positions aggressively during forced sell-offs. As Andy Schectman points out here, a $3 million bet targeting gold between $15,000 and $20,000 isn't speculation. It's a macro hedge against systemic stress. This kind of positioning reflects expectations of rising debt, persistent inflation, and geopolitical disruptions like the Strait of Hormuz choke point. Retail exits during volatility, but institutions often use that liquidity to build asymmetric upside trades. The real question isn't if prices rise, but what breaks first to justify those targets. Next, Andy Schectman discusses the macro triggers behind these extreme bets.
In October, we just got a report that China has decreased its stockpile of U.S. treasuries to $688.7 billion, the lowest in 17 years. So the Fed's in a corner. They can't raise, they can't lower. If they lower, inflation is reignited. If they raise, the whole system breaks. And here we are, the Treasury up to 4.4% on the 10-year. Bonds are being sold. So that's the Fed's nightmare. Let's see, anything else? I think that's about it. Any questions you got for me, my man? I know I went on a ramble. Thank you for letting me do that.
No, we love that, Andy. Thank you so much. Actually, this whole scenario that you've described, it could be summarized, I guess, with the term bash and stash. It's been used for decades and decades to describe typical maneuvers that happen on all markets, but especially on stock markets, but here in the metals as well, where you get the as you say, the deceptive price action, which is often engineered in various ways that you've described, combined with negative press and all kinds of stories that are spun out there, whether it's in the mainstream financial press or whether it's also in mysterious AI-generated social media channels that pop up, podcasts, that sort of thing, all seeming with a common voice to be giving plausible reason why, which makes no sense if you look at it in historical context as you have.
The real pressure point isn't inflation. It's the collapsing demand for U.S. debt. As Andy Schectman points out here, China cutting Treasury holdings to $688.7 billion, a 17-year low, while the 10-year yield hits 4.4%, signals a structural shift in global capital flows. The Fed is boxed in ahead of key policy decisions: cut rates and risk inflation, hike and risk systemic stress, leaving markets vulnerable to volatility spikes. Bash and stash isn't just theory. It reflects how narratives are shaped to justify engineered price moves. Next, Andy Schectman unravels how narrative control influences investor behavior.
Why there should be a rapid movement down during times of geopolitical stress, that kind of thing. But it's an opportunity for those who are orchestrating this to acquire, as you say, historically record amounts of physical in a very short period of time. There was a post that came out on X we wanted to bring up, and I'll put a link to it if we can in the description of this video. And this is about a top Swiss asset manager giving the reasons why we're expecting a quarter-end bash and stash here, and why it's an incredible opportunity for those who are paying attention and not just reacting like the herd to.
He's saying that the whole thing gets better because at the end of the quarter, everything turns around as the options expire worthless that were sold. And yeah, it's an interesting, I watched a video, Alistair McLeod posted some stuff about it. It's very interesting. I think people should check it out. And it's a lot of what we just said.
Now, in addition to that, I don't believe you went into this particular portion of another theory about Jane Street scandal that's already been that's being prosecuted in India, but why that might also affect the broader markets here, affecting the U.S.
Sharp declines during geopolitical stress should signal fear, but here they're triggering accumulation. As Andy Schectman points out here, the idea of a quarter-end bash and stash aligns with options expiration cycles, where prices are often pressured to render contracts worthless. This suggests timing, not fundamentals, is driving short-term price action, something long-term investors often overlook. When institutions accumulate physical assets during these engineered dips, it creates a widening gap between sentiment and reality. Retail reacts to headlines, while capital rotates quietly beneath the surface. Next, Andy Schectman discusses how these cycles may impact broader market stability.
Yeah, there's a lot of people who think that there's a high probability. Look, on one end, you look at Jane Street, who's already being prosecuted by India, and at the same time, the other end, the co-party on this would be JP Morgan, who paid a $920 million fine for manipulating the market and has been given more or less sovereign immunity, it would seem, on a large scale, even though they had jail time for their head trader, Michael Nowak, and even though they paid that fine of $920 million, the desk made $1 billion that year. They walked away up $80 million and are still allowed to be the custodian of the world's largest silver trust. So, did they really get anything other than a slap on the wrist for manipulating the market? But the theory is that they had about 40,000 shares of SLV, and then within a month, they ended up having over 20 million shares, the largest holders of SLV, the largest holder of SLV. And the theory is that they then loaded up on the other side with massive amount of options. This is what they did in India, massive amount of options that would profit if the price fell. So they become the largest holder of silver, period, SLV, rather, and then load up on options on the other side, which are harder to discern that they own them, and they profit when the price falls.
Regulatory penalties often look severe, until you compare them to the profits they protect. As Andy Schectman points out here, a $920 million fine sounds significant, but when the same desk nets $1 billion, it raises questions about enforcement versus optics. The rapid jump from 40,000 to over 20 million SLV shares suggests aggressive positioning that coincides with complex option strategies designed to profit from downside moves. This isn't just trading, it's structural influence over price direction. Investors need to recognize how asymmetric strategies can distort market signals. Next, Andy Schectman unravels how these positions may have been engineered.
So they load up on silver and then dump it as the price falls and make 10, so they lose on their shares, on the 20 million shares they own, but make many times that on the options as it goes the other way. And that is the footprint that many believe has been left in the snow, so to speak, and that this was all contrived. Now, if it was contrived, let's take the opposite side. Let's take conspiratorial side of it. If it was allowed to happen, it would have been allowed to happen to get the banks on sides. Now, could that really be how things get played? Yeah, why not? If Trump and the administration said, you guys have had this position for far too long, the world is accumulating this stuff, we've just designated silver to be a critical mineral. The European Union did it a year and a half ago. China did it in November, saying all of their domestic production will not be sent abroad. It's for domestic consumption, and they're going to limit exports. It's time for you to get on sides, and we'll leave the banks in Europe and Canada exposed to this, but you need to get on sides. Well, how do we get on sides when silver's at $100 and we have short positions at 60 that are bleeding? Well, we're going to give you one last chance, and we're going to get Jane Street involved.
Sometimes the biggest profits come from losing in one place and winning bigger elsewhere. As Andy Schectman points out here, the strategy of taking losses on physical holdings while massively profiting through options reveals a layered market structure most investors never see. The designation of silver as a critical mineral by major economies adds a geopolitical layer that could force repositioning among large institutions. If policy and market structure align, price discovery may be less organic than assumed. This raises serious questions about how free these markets really are. Next, Andy Schectman discusses whether this repositioning was coordinated.
Now, could that happen? I don't know. If you watched, as I've said many times, the Chris Marcus or Andrew Maguire interview with Bart Chilton. He did two of them. And at the very end, when Bart Chilton says, I went into my superiors and said, JP Morgan is in violation of our agreement and antitrust law. They need to be prosecuted. He said, I was told by my superior, which would have been Hank Paulson, the Treasury Secretary, to back down Bart. It's a political decision. We've seen it before. We had the head of the CFTC admit this twice, that this happened. Could it be that this administration really understands where the U.S. banks are and that there is a change in ideology, and the only way to get on the right side of this is to smash the hell out of the price so that they can get on sides and cover these shorts and be net long, as the Economic Times suggests? Look, Ed Steer just said it's the lowest short position ever in silver by the banks. Just said that. So could it be? Maybe. Maybe they've covered those shorts and they will benefit on the upside as silver is now a critical mineral. Project Vault, we're going to accumulate a state-sponsored government stockpile and price floors underneath it to incentivize domestic mining. There's a fine line between conspiracy and reality, Dunnigan, and I don't know sometimes which side is right, but I will tell you that it's a little bit interesting that this happened and, with a company that's under investigation already and it's the same playbook. I don't know. It's, I think if it walks like a duck and talks like a duck, is it a duck? Kind of seems that way.
When enforcement becomes political, market integrity turns into a narrative choice. As Andy Schectman points out here, claims that regulators were told to stand down, even after identifying violations, suggest that market structure may be shaped as much by policy as by supply and demand. With banks reportedly holding their lowest short positions ever, the timing raises questions about whether price suppression was used to facilitate repositioning. Government-backed stockpiling and critical mineral designation could further distort price discovery going forward. Investors should consider how policy incentives influence market outcomes.